Hello and welcome. Excited to be with you today. My name is Denny Fulk. I'm a wealth management advisor with Northwestern Mutual. We're going to have some fun today. Nothing better than nerding out over some financial planning. Excited to be with you. And let's just hop right in. I want to start by saying, first and foremost, that it is never too late to start making progress in your financial plan, regardless of how old you are, where you are in your career or life. Every day is an opportunity to make improvements and to start building positive momentum. So today we're going to spend time talking about a few tactics and mindsets and real life examples that hopefully you can take with you today to share with family, friends, or just put in action for yourself. So let's get going. And I'd like to just first and foremost start asking everybody to have a pen and paper ready. I want this to be interactive. I want you to be able to write down your thoughts, maybe even questions as we go along. And if you have questions, by all means, feel free to email me and our team. Happy to have conversations that are more unique to you and your specific financial goals and needs. But let's first and foremost start. Do we have our goals written down? It's amazing the impact of taking time and putting pen to paper and writing these things down. And this could be as simple as a goal of exactly when you want to have 6 months of an emergency fund in place so that when unexpected bills or even expected bills come, you've got the right cash reserve in place to not have to turn towards credit cards or any other type of debt. It could be the goal of when you want to buy the next house or car or have the car paid off, whatever it might be. Let's have these things written down. The power of actually writing down goals and revisiting those goals regularly is unbelievable. So whether that's one goal today or your top 5, my encouragement would be to write these down and share it. Share it with your spouse, your family member, a mentor, someone that you care about and love, so that you can be each other's accountability buddy in this thing. When looking at just the 5 key actions of creating financial security, we start with saving, spending, growing, protecting, and giving. And we're going to spend some time going through the fundamentals of how we can make each one of these actions as efficient as possible. So when we're thinking about saving, having that goal of what exactly it's for, we can think more strategically about, hey, how do we approach what's more important and put priorities behind where dollars should go. Should it go towards paying down debt? Should it go towards our emergency fund? Should it go towards retirement? It's a balancing act on all of those things. And we'll spend some time today talking about the thought process and the mindset that you can have behind when it's the right time to save for a rainy day or emergencies or expected bills that we all face, versus spending and enjoying those dollars versus saving them for the future financial independence and that day where we don't necessarily have to work to make money anymore. So it's our experience that setting these short-term financial goals first is most impactful. Then thinking about 5 to 10 years out, and then thinking the big picture long term. And so a lot of the tactical decisions that you can make today on these short-term goals are really easy to implement quickly. as long as we just focus in on one or two. I think that everybody, me included, get a little overwhelmed at times when you start thinking about all the things that we need to do, regardless of whether that's personally, professionally, or financially. So especially with finances, we find that let's keep it simple, right? And start with these short-term goals first, and then start building on that momentum to say, hey, I'm making progress here. What does life look like 5 years from now, 10 years from now, 30 years from now, beyond then? And the clearer we get with what we want, the easier it is to make decisions. So let's just start by talking about, how much really should we be putting away? And this chart and this mindset of having 20% of our income saved or invested is a fundamental that we should all be able to get our arms around and make it a part of our habits, to say that 20% off the top needs to be saved. And in certain cases, 401k can be a really easy way to start by taking advantage of whatever the company match might be. If your company is generous enough to offer a match, then that is free money. And it's tough to beat free. So if it's 3% or 5%, or gosh, sometimes it's even as high as 8%, take advantage of that free money first. And if it's at 5%, great. That means that there's 15% more out there that could be saved towards emergency fund or future costs that we know might be coming our way. Then the next 20%, discretionary spending. Discretionary, that's the one that can get away from us, And by no means are we the budget police. We want everyone to enjoy life and spend and give generously. But if you keep that discretionary towards the 20%, then that leaves us now 60% of our income that is essential. So our encouragement is that everyone today has received the cash flow analysis worksheet, the monthly budget worksheet, and get that worksheet done, guys. Take a look at your average spending. Take a look at your last 3 or 4 months bank statements or credit card statements, and curl up with your favorite beverage, and it's beautiful weather right now. Be out on the patio or porch and comb through those average spending habits to really take a look at what are we doing right now. Now, granted, given COVID, this is a little different scenario. Maybe we're not eating out as much, we're traveling as much. So a good exercise would be to take your 2019, if you have a credit card, 2019 year-to-date statement. A lot of credit cards are good about being able to just give you your year-to-date spending, and they break it down in different categories. If you got that and threw it away, maybe call them up and ask them to send you another copy, because 2020 has been a little different. But an easy place to start would be the last 3 months of combing through your bank statements to say what's essential and what was discretionary and what's already being saved or invested. And when it comes to saving and investing, the real trick here is making it automatic. And that's one of the beauties of a 401k, is it can be taken out of your paycheck before we can spend it or waste it. But a lot of times your employers will also automatically allow you to make maybe 2 different automatic deposits. So that could be as simple as saying, you know what, take $100 out of every paycheck and just put it over to this separate savings account, and making it automatic. In many cases, it's good to have a separate savings account that maybe is online or with a financial advisor that creates a little bit of a barrier for you to get to. obviously you need those funds in an emergency, but if it's not just sitting connected to your normal Wells Fargo or Bank of America or wherever you bank with, it's not sitting there in that separate savings account. When you pull up your app or log in, it's that mental mind shift that helps a little out of sight, out of mind, do some magic for you. And this increasing our savings by 1% each year, frankly, there's a lot of 401k plans that give you that option to automatically elect a 1% increase each year. So it just makes it automatic. And our experience shows that those who set up these systems to have money automatically saved and invested are far more successful and reach financial independence far earlier than those that don't set it up to be automatic. So this slide here is great for giving the timelines as you put job descriptions behind the dollars that you are saving. And we'll see if we think short term or focus on the short term, usually short term is more of a 2-year short term potential goal or expense that is there. And that's why the Certified Financial Planning Board generally recommends having 3 months of your average expenses in cash or checking and savings accounts if you have 2 working incomes coming in. If there is 1 income coming in, then the recommendation is 6 months of emergency funds in place. And so especially with potential extra medical bills and costs, certainly it's never a bad thing to have more than 6 months of your average spending in cash or CDs or money market that you can get to, so that we don't have to turn towards credit cards or other types of loans to cover potential big costs. Put that as a goal. If you've updated the cash flow analysis, or when you get that updated and you take a look at that average spending, then it's really easy to say, okay, 3 months is, $15,000. That's our goal. That's our first short-term goal, to arrive at a place, whether that's a year from now, 2 years from now, 6 months from now, whatever it might be, to say we've got 15,000 or 30,000 that is stocked away for that emergency or rainy day fund. On the far end of the spectrum, so towards the retirement side of the screen, where it's 401k, traditional IRA, Roth IRA, annuities, that's the bigger picture savings. And especially when there's 401k match in play, that's the first place to start with free money to take advantage of. The mid and long-term buckets in between there, those could be more of after we've got our short-term in play and we're taking full advantage of our 401k match, potentially looking at say a Roth IRA before looking towards investment accounts or cash value life insurance. Those are places that could be later on in life when we've gotten a real good solid foundation of an emergency fund and taking full advantage of employer-sponsored retirement plans and maxing those out. As a refresher, retirement accounts, so 401k, the maximum amount you can put into that account is $19,500, and that's if you're below the age of 50. Once you hit age 50, there's a catch-up that allows you to save even more, so an additional $6,000 can be saved there. And then within IRAs, whether it's a traditional IRA or Roth IRA, the maximum contributions is $6,000 per person per year. And then there's a catch-up amount of an additional $1,000 there once you're age 50 and above. So when thinking about good places or smart places to be able to put money away as it relates to that savings of 20%, depending on your individual and your family situation, it might need to be a little bit more heavily weighted towards building up that emergency fund or paying down some debt if there is any, before then turning up the nozzle and saving a little bit more into our 401ks and IRAs. A quick note on 401ks that if you've changed jobs recently, you may want to explore rolling those old 401ks into your new employer's plan, or explore rolling it into an IRA, an individual retirement account. There has been an update with COVID that it does allow you to access money inside of IRAs and 401ks without a 10% penalty, but you are still subject to tax on that if it's traditional 401k or traditional IRA. So that should be the last place we're looking to pull money out in the event of an emergency or costs that just came up that weren't expected. But our encouragement would be to talk to an advisor about this before making any decisions there. But just as an update, that 10% penalty that is previously in place for accessing money in 401ks or IRAs is currently waived due to the COVID pandemic. So hopefully that's helpful as you just navigate 2020 and move into 2021 as well. So let's talk about spending, right? Spending wisely. When we've done the good, budgeting and cash flow, this is one of the fun things about putting pen to paper is that you can give yourself the green light to spend and put a dollar amount around what is, a meaningful and doable number that still allows you to enjoy life, have some fun, create some memorable experiences with family and friends. Again, by putting pen to paper and knowing really what our fundamental fixed expenses are, then it can help give yourself the green light for spending a little bit more. So this budget and cash flow worksheet, we couldn't stress it anymore to make sure that this is updated maybe every 6 months, but at least once a year, because things add up. Whether it be growing family or changes a job, there's fluctuation. So our encouragement is every 6 months to update that cash flow analysis worksheet. So when we've got money freed up and we're managing debt, a key concept around managing debt is where to start. Where do we start if there is credit card debt in play, or student loans, or mortgage, or car payment? In general, starting first with credit cards is the best place to start because those interest rates are typically the highest rates. So if there's credit card debt in play, first, make sure you know exactly what those interest rates are, what you are really being charged for that debt, and start with the highest interest rate card and focus on paying that down first. There are a handful of credit card companies that do offer, in some cases, 12 to 18 month 0% interest. There is a transfer fee. Everybody's a little bit different, but if you haven't explored that and you do have some credit card debt in play, that can be a good way to transfer some from a high interest credit card to a either lower or 0% interest credit card and buy you some time to pay off the higher credit card debt and then move on to either the lower or 0 credit card debt to arrive at a spot where we can have absolutely no credit card debt in place. The goal would be to make sure that anytime we put anything on credit, that every month we can pay that off in full. For one reason or another, sometimes people feel that it's good to keep a little bit of a balance on a card, and that's really not the truth. They're like paying off the full amount each month is the route you want to go. Moving then to potentially student loan debt. Again, there are student loan forgiveness programs that are worth being aware of. There is student loan consolidation options that are worth exploring. If you have some higher rates on some loans, you could look at consolidating and getting a moderate rate in between those. But it's certainly worthwhile to make sure you know all the rules of student loan forgiveness, if it is an actual option for you in your profession and where you are in life. But there's also loan consolidation options to explore. Then managing your mortgage debt. Right now, we're in unprecedented times with such low interest rates that if you haven't refinanced, it could be a great opportunity to look at lowering your monthly mortgage payment and free up some extra cash flow to help towards that goal of either saving more towards retirement or emergency fund or even paying down debt. So a lot of great ways that you can gradually be able to improve that balance sheet and any interest that you're paying on either credit card, student loans, or your mortgage. So let's talk about growing, having some fun with putting money to work, right? Again, if we start back at the fundamental, like really, what are we investing for, right? Is this financial independence? Is this not having to work to make money anymore? Or is this, maybe a 5-year goal of being able to roll out and start your own business or help a family member out? That time horizon makes a big difference on how you should invest your funds. And we'll talk about the premise of diversification. So diversification, everyone's heard of, they know the word, but it sometimes can be confusing about what the phrase not having all of your eggs in one basket actually means. And when speaking about long-term investing, that asset allocation is the most important driver of your long-term rate of return. And asset allocation means having exposure, having different investment asset classes inside of your 401k or IRA or investment accounts to give you diversification, which means that you're going to take on less risk than just going out and trying to buy one stock, because that one company could go under. So buying multiple stocks or mutual funds or index funds can be a great way to diversify. Then when we're talking about protecting our family, our loved ones, planning for plan A, having a clear goal of what plan A looks like, and that's living long, healthy lives and having enough money for our family and friends to not only pay the bills, but also spend and enjoy and give. We also need to plan for, if we were to get sick or hurt, and some of the things that we can do, even if we die prematurely. And so, in the event of an injury or illness that prevents us from being able to work, most employers do provide disability income protection, whether it's short-term or long-term. It's key to know what those plans actually offer you. So it's open enrollment season for a lot of companies right now. This is an excellent time to be able to gather the benefits and really dig into what you have in place and other options in and outside your employer in the event of an injury or illness. Most employers are giving roughly 50 to 60% of your average earnings or regular salary in the event of an injury or illness that prevents you from being able to perform your job, that could pay a benefit to you while we're working through this illness or the time frame that it's taken away from work. So encouragement is to understand what they have in place, but also seek guidance from others of additional coverage that's outside of your employer to be able to protect future income. Some insurance carriers are open to offering policies, and others are not, depending on pre-existing conditions. but the answer is always no until you ask. So worst case scenario, you ask and see if you can qualify for additional coverage in and outside your employer. Then life insurance, having enough life insurance in place, God forbid we die prematurely, to enough to cover the mortgage or make sure that we maintain a standard of living. In many cases, you have employer-sponsored plans, but again, if we change companies or get fired or they just change the benefits, you may not have any coverage anymore. So owning your own individual life insurance that you can take from job to job and that you are in control of is fundamental to being able to have a sound financial plan and protect in the event of worst case scenarios. Long-term care. This is another way to plan for the future. The potential costs that needing assistance for activities of daily living. This is something that, just like anything else, the earlier we start, right? It's never too late to start. The earlier we start planning for ourselves or spouses or loved ones, the better off we'll be. And long-term care, the cost of care is increasing at around 5% each year because we're just living a whole lot longer, and so those costs and the future potential costs of being able to provide in-home or assisted living or even 24/7 nursing homes is something that needs to be planned for. It just doesn't happen like that. And this is one of the mindsets of like keeping our mind and our body healthy and taking good care of ourselves mentally and physically to be able to work longer. Maybe the dream of not having to work at by age 65 isn't necessarily in the cards due to changes in health and the scenario that we're in. Well, having a plan that maybe working till 70, as long as we're healthy, can make a huge difference of 5 years of extra 401k contributions, compounding interest, all those great things that can work in your favor to plan for these types of events. Finally, looking at giving and how we can transfer our funds with us to church or charity or those we care about, family members. That similarly, writing down in our budget and our goals things that are important. If gifting and making a difference to others is important to you, we put it in the plan. And studies have shown that we maintain happiness and feel much happier about giving than we do getting. As it relates to staying happy and having a good outlook on life and helping others, the long-term benefits of gradually giving, what's in your heart and what's in your mind to others can also help in the long run. So strategies on giving, one, you can make it automatic. So that's one thing that even if it's $5 a paycheck or a month going to an organization, it all adds up and can make a difference for not only you, but your family and your community. We've spent a lot of time covering a lot of things that you can do to improve your financial picture today. And I'd like to just circle back to really where we started, and that was writing down the goals that are most important to you today. And if we can come away with at least one, if not two action items that you can put into play tonight or over the weekend and build on that momentum, then I feel that this time has been a success and worthwhile. And so whether that is completing that cash flow analysis yourself or with your spouse or a loved one, and putting pen to paper, or writing down a goal of exactly how much we're going to have saved up in our emergency fund by that date, and print it, put it up on your bathroom mirror, have it as a reminder in your phone. Make sure that somehow it's top of mind and that you're seeing it on a daily basis. I can't stress enough in the power of those written goals, and finding a partnership with somebody that's in the financial services industry that you know, like, and trust, that you could continue having a conversation more tailored to your family, your specific needs. But the value of being able to have a proper emergency fund, again, as a refresher, 3 months of average spending, if there's 2 incomes coming in, 6 months of average spending if there's 1 income coming in, to be able to make sure that we don't have to rack up any type of credit card debt, or take out any other loans for unexpected costs. And some tips on even just the mindset about what financial independence and financial freedom means to you, that as long as we have the ability to get out of bed and work, and generate an income, we can make a positive impact on our community and our colleagues and our family to continue serving. And in some cases, it may be as simple as deciding to work longer so that you can have health insurance benefits for longer. If you have a passion for building or kind of fixer-upper, working at Lowe's or Home Depot, to be able to have the benefits for longer, or being able to stock money away in a 401k for 5 more years and get that compounding interest and extra capacity of savings, can make a huge difference. But everybody's financial plan is unique, and encouragement would be that you find a trusted partner that you can have a conversation with, so that they tailor these decisions and can help brainstorm on your behalf of what really would be in your best interests. So happy to take questions via email, or you can contact our team with questions or inquiries and how we might be able to serve you and your family. But I thank you for your time, and hope you have a great week. And we make baby steps that are going to make a real big difference in the long run.